Okay, I think we're going to go ahead and get underway. Again, welcome everyone to the release of the World Resources Institute UNEP Finance Initiative Carbon Asset Risk Discussion Framework. My name is Chris Weber. I'm with the World Resources Institute and UNEP FI, and I will be introducing the presentation today. I would have to just start with a standard disclaimer language. I think everybody works in the finance is well aware of all of these things. But just as one particular note, we are recording this session, and both slides and the recording of the portion before the Q&A session will be posted online along with the report on the WRI website. In terms of logistics, I just wanted to quickly cover this. All attendees are going to be on mute for the duration of the webinar. This is purely for sound quality reasons. And if you do have questions, please type them into the question box. You can do that during the presentation or after the presentation. We'll stop and take questions, and we'll answer them basically in the order they were received. In terms of the schedule, obviously I'm starting here with about 5 minutes of just welcome and logistics and a bit about the background process. I'm then going to turn it over to Marissa Buchanan, who is the Vice President of Sustainable Finance at JP Chase and was the technical working group chair that spearheaded the effort of producing this report. She's going to give a brief introduction to kind of background of the process summary, as well as JP Morgan's perspective on why this was an important endeavor. Then we're going to turn it over to Mark Fulton, who is the founder of Energy Transition Advisors and was a consultant to WRI on this framework and one of the primary authors. He's going to do a summary of the report for about 15 minutes, and then we're going to have comments from Rosemary Bissett, kind of a regional perspective. Rosemary is the head of Sustainability Governance and Risk at the National Australia Bank. Following that should be about 30 minutes for the session, and we'll then turn it over to Q&A. As a very brief background before I turn it over, this is one of the 3 outcomes of what is called the Portfolio Carbon Initiative, which is led by UNEP FI, WRI, as well as the 2 Degrees Investing Initiative. Basically, the history is that UNEP FI and WRI, for those who are not aware, we're working on a process related to financed emissions. That process, which Marissa will touch on a bit, was restructured in the middle of 2014 to focus on 3 different work streams. One related to carbon asset risk, which is this report, but I did just want to quickly highlight before Marissa talks a bit more about that there are 2 other work streams. There's one, both of them are related to assessing the assessment of climate metrics for the assessment of how basically what we're calling climate-friendly financial portfolios are and we split this into investors and banks. This work is ongoing. The investor work is very close to done and was released in draft form back in May, but will be finalized this next month. And we're just kicking off next week, actually, the technical working group on the follow-on report for banks. So for those who are interested, please look for the follow-up email to this webinar, and we'll be sending some information about that. So with that, I'm going to turn it over to Marissa Buchanan.
Thanks, Chris, and hi, everyone. This is Marissa Buchanan. I sit in the Sustainable Finance Group at JP Chase, and as Chris said, I served as the chair of the technical working group that provided stakeholder input to this carbon asset risk discussion framework that's been in development for the past couple years. As Chris explained, Mark is going to spend some time actually diving into the content of this report, and before we do that, I wanted to spend just a few minutes talking a little bit about the background of this project, how it came about. I think there's some important context here, and also wanted to talk a little bit about the objective of this framework and why we think it's a valuable contribution to the dialogue on this topic more broadly. So just to start on the background, as I'm sure some of you probably remember, I think it was back in 2012 originally, both WRI and UNEP launched a process to explore developing what was essentially a more detailed methodology for financed emissions accounting. And financed emissions accounting is basically the idea that banks and investors would calculate and report essentially their Scope 3 greenhouse gas emissions associated with lending and investing activities. So these are indirect emissions associated with financing, essentially. And as these discussions around financed emissions accounting and methodology development were happening, it also really kind of coincided with a broader dialogue that really emerged around climate change and financial risk. And this was a dialogue that really got started in large part due to topics such as unburnable carbon and stranded assets. The whole debate around fossil fuel divestment and things of that nature really got underway. And I would say these two conversations kind of came together in some degree, and there was some initial thinking that by measuring financed emissions, it would provide banks and investors with a means of evaluating potential financial risk associated with lending and investing, in particular with, for example, fossil fuel companies and other companies that emit greenhouse gas emissions. Now, as this process got underway and really evolved, I think there came to be a much broader realization that certainly while having the tools to assess and think about carbon risk is very important for the financial sector, financed emissions accounting doesn't actually give you a measure of potential financial risk. And so recognizing that gap, WRI and UNEP decided to start what turned out to be a separate but parallel process that really would be focused on developing a framework that would really do just that, and that's to really help banks and investors, but as well as other stakeholders with a broader interest in these topics more generally, to think more systematically about carbon-related risks facing companies and the circumstances in which these risks may or even may not translate to financial risks for banks and investors. And this is a concept, what we call carbon asset risk, that Mark is going to talk in more detail about in the next several slides. So Chris, if you want to go to the next slide. So just to kind of hone in on the objective, this process kicked off in February 2014. We had, I think it was over 80 stakeholders participate through this multi-stakeholder process. And like I said, the goal was really to create a framework to really help readers understand how to think about these issues conceptually and more systematically, not what to think. I think it was important from our perspective to ensure that readers had the framework and the tools to be able to think about these issues more systematically and really let users bring their own judgment to the table and make more informed conclusions and decisions about frankly what's become a very important and much discussed issue. I think we recognize through this process that different banks and investors have different business models as well as constraints and mandates, but also different opinions about some of these carbon-related issues. And one thing I should just point out so it's clear, this framework focuses on non-physical risks associated with climate change. So this is what we call carbon-related risks. These are really the economic and policy, technology, market, and other non-physical risks that could potentially impact companies and thereby extension potentially impact lenders and investors as well. And before I turn it over to Mark, I just want to end by saying, I think in many ways, as you'll see, the concepts in this framework are not rocket science. I think, many of them will be very familiar. Part of the power of this framework is that I think it lays out a framework to get, folks interested in this issue thinking and speaking and communicating consistently. I know sometimes that hasn't always happened in this broader dialogue, and hopefully it lays out a very clear framework for how to think about these issues and really equip readers with the tools and the information in order to do thoughtful and informed analysis and reach their own conclusions. So I do want to thank through this process the drafting committee. We had a small group which put a lot of time and effort into developing the initial chapters. Certainly our technical working group participants, many of whom provided extensive comments through this process. And I also want to thank Mark Fulton and Chris Weber, who did a tremendous job on this framework and shepherding it through. So thank you, and with that, I'll turn it over to Mark.
Thank you very much, Marissa, and thank you, Chris. Hello, everyone. It's Mark Fulton. I'm talking to you today from the United States, where I'm here. And I think I've spent about 35 years in financial markets in investment banking research roles, and 20 of that was actually in Australia. So I'm sure I would know quite a lot of the Australian participants on the call, and so good day to all you guys. So in the last 5 years, I've been working more with NGOs, having left Deutsche Bank Climate Change Advisors, and working increasingly on carbon asset risk as well as on the green side of what's going on in climate. So given that background, I couldn't help but give you this recent market context, commodity markets. Again, talking to Australians, there's no need to make the point that there's been a lot of volatility in commodity markets over the past few months, if not the past few days, exceptionally so. So I think the interesting question is that given that carbon asset risk is so heavily concentrated in fossil fuel sectors which are exposed to their key commodities, what role does any of the longer term trends, which I'd like to term the energy transition trends, what role does that play in these recent volatility and big falls in oil, gas and coal prices? Now I don't have a bullet point on here, which I should have, which is Chinese coal demand. Essentially I would actually tend to start with coal and say that last year at Carbon Tracker we put out a report saying that Chinese coal demand might peak in 2016. And of course, at the moment, the question is, has it already peaked? I think that is there's very long-term features in there. It's not just cyclical. We think the Chinese are really serious about air pollution and so on, and that is really starting to restrict the amount of coal that they're requiring. So I think there's an example playing into the coal markets. In the oil markets, it's always going to be way more complex. There are so many different features going on in oil markets, but I was very taken by Sheikh Naimi, the oil minister's statement that Saudi Arabia recognized that by 2040 or 50 they might not need fossil fuels, and that Saudi Arabia plans to be a global power in solar and wind energy. So at least somewhere in the minds of the world's biggest supplier, and importantly, again, going back to the Carbon Tracker supply curve thesis, our position last year always was beware the low-cost supply in OPEC and Saudi Arabia wishing to get to market as they started to believe that there was only so much oil that was going to be used. So there are some, I think, of these very long-term trends which are showing up, and I think this is a very interesting area and a very interesting time to be looking at these issues. So if we turn to the next slide, the structure of the document. So essentially, we're assessing the exposure, and we have 3 chapters looking at that. We're evaluating the risk, and that's the stress testing. And then we're managing the risk, the different ways we can manage it from engagement, divestment, diversification, and so on. So that's the structure of the document. On the next slide, I think there's one idea in here that I find particularly appealing that I think is important, and I think it's as if people know this, but they haven't necessarily pulled it out quite in this framework. But we believe you have to distinguish between what we call operator carbon risk and operator carbon strategy, and that is at the asset level, whoever really owns those assets, usually a company. And then we've actually got what people think of as carbon asset risk, which is usually the risk that's being carried by a financial intermediary or an investor, where they could experience financial loss. But in many senses, that is the residual risk that's coming out of the operator. The operator can manage the risk itself, either at a micro asset level or across the diversification of its operations. And increasingly, what I'm going to show, I think, is that, or we feel, is that the market and investors really are heavily focused on operator level risk and asking about it and seeing if it can be tackled at that level, I think that the carbon asset portfolio risk, which we'll look to, is only really a few people are looking at, and there are a few tools to do it. But I think, you know, at the moment, globally in particular, there's a lot of focus on, well, let's ask the operators what the risk is and what they're doing. So if we now look on the next slide. So Marissa talked about these risk factors. So there are 4 risk factors, 3 grouped together as fairly classic in terms of markets. You've got policy and legal, the obvious point being regulations, global carbon policy, and so on. Then you get technology. I'm a great believer that technology is going to be perhaps the big driver in the next 20 years myself, as we see further breakthroughs in the cost of alternative energy efficiency. And of course the big one might be is anything looming in carbon capture and storage that the fossil fuel industry hopes to see but doesn't seem to be really investing huge amounts of money to find. So essentially technology a very important factor. Then we get to market and economic, and that really is about my intro chart in effect. We've always felt that carbon asset risk is about key sectors in economies, and you can't entirely, you know, unwind that from what's going on in the macro economy, and particularly some of the assumptions you might make, like Chinese growth. And again, I'd go back to it, you know, for us, we felt that fundamentally one of the big misses might be in the fossil fuel industry, too much bullishness on the Chinese growth story. Well, obviously, cyclically, that's proved very correct. The question is, will that prove so in the medium term? So again, we get changes in fossil fuel prices. Now, the last factor is we put slightly separately because we call it, it's reputational risk. So it sort of sits outside the general impacts on markets. But we think it's very important. It's very important for, in fact, investors and asset owners themselves. They might be carrying some of this reputational risk, depending on what they're doing. But I think in particular, it strikes me for financial intermediaries. This is very important because often we hear from financial intermediaries that are have loan books or have all sorts of, sorry, I have to turn my phone on. Have all sorts of different books that they're running that they are that they can get them off their books very quickly. So there's not really a lot of real balance sheet risk for them. But I believe that if you're an underwriter or you're involved in financial intermediation and you're part of making something happen, then indeed you're going to carry a lot of financial risk. In the medium, so a lot of reputational risk in the medium term, because people can look back and say, well, you helped get these assets to market. So I think reputational risk is very important for that sector. Turning to the next slide. Here we're looking at, okay, so how do we assess who's really in focus? And there are no real surprises here. Here, though, we use Scope 3 product emissions data as well, which is going to be very important to identify what we obviously see, fossil fuels, coal, oil, gas. Then we get into fossil fuel dependent infrastructure. Again, no surprise there, we see utilities. Then we get into high carbon assets facing a shift to low carbon technologies. The airlines, obviously, you know, are fairly notable there. And then we get to the high carbon assets that don't have low carbon, they don't have much competitors in the low carbon sector, and therefore probably there's not much implications for them at this time. So if we look on the next slide, essentially, we look at that again, we lay those out, but we insert another feature here in the final column, the particular asset classes that are in play. And again, no surprise, equities, bonds, sometimes project finance, corporate lending. And then I do point out that there's a very good chapter in chapter 4 and a detailed appendix that really looks at what we call the capital stack in the document. So we do go into some detail as to how the different types of capital can interact with these different exposures. And they will be important when you come to assess your portfolio. So turning to the next slide. So now we get into, you know, the key area in a sense, the operator level stress test. So again, the first point we would make is time horizons here. Obviously, this is going to be heavily dependent on time horizons. You know, if you're taking very short term, maybe you're going to not see so much effect. If you're taking 20, 30 years, you might see a lot more. So that's a key idea, and we certainly go into that, and we recognize that. I would make one aside, though. Often I feel the time horizon issue is somewhat used as an excuse that maybe nothing's going to happen very quickly, and therefore, you know, it's not in my career sort of problem. Actually, I think the problem is that markets move very, very fast. So you might think that the cash flow horizon of the problem is 20 to 30 years, but if the market believes that problem is starting to become priceable, then of course you need to discount those cash flows into an NPV today, and you can get very big moves in asset prices. And so I think the time horizon is interesting in one way, but I think markets have shown us yet again, be very careful. You don't have as much time as you think when the market decides something's going to happen, even very long run. Anyway, so you can see we take our risk factors, we take the operator level, we get a financial asset screen, we pass that across through the macro scenarios. Now the macro scenarios are naturally going to be the IEA scenarios for climate, the IEA scenarios for low demand, and other scenarios for low demand. They're obviously about demand. Will demand be fall short of what the industry thinks? And that is the stress test. So while the industry may turn around and say, oh, we have a low probability on a 2-degree outcome, the question is, but have you stress tested, and can you tell us what would happen if you are wrong on your probabilities? So we always ask for a 2-degree stress test, even though, true, at the moment the probabilities are much lower than NPS. But that's the IEA new policies scenario. But I think we're about to see an updated IEA new policies scenario, which will be much more, much lower demand. So I think that whole area is key, and that flows through to the simple point I was making earlier, cash flow and revenues in whatever the asset structure is. And from that, you can use classic valuation models, NPV, IRR, break even, and some people like to use value at risk and look on that longer term horizon in that way as well. But the classic valuations at the asset level tend to be the ones shown. So that's the type of financial analysis. Now again, I think a lot of investors are looking for the companies to do this and disclose it. So that seems to be where the action is at the moment. They're probably a bit more focused on asking their companies about what it means for them than necessarily applying it to what they're doing in their own portfolios. But if we look at the next slide, if you want to look at it at a portfolio level, you can do company level analysis of your own. You can stress test what you know about companies at the company level. But when it rolls up to the top-down portfolio level, then we're getting towards what we all have seen recently, a model like the Mercer TRIPS model, which actually has two factors are on impacts, 2 factors, technology and policy, are on what we're looking at. So we have more emphasis, we have much more emphasis on the technology, the policy and the markets, and no impact. But what Mercer's doing here in a stylized view of what these sorts of models would do is identify their risk factors. They would test the relationships between those factors. They again would run it through a macro scenario stress test, such as an IEA assumption. They would assign their risk factor assumptions, and then they would get to analyze and optimize the portfolio at a full optimized level. And again, using Mercer as the example, I think as many as you will know, their conclusions were there's a lot of sort of effect at the sector level. There is some effect at the asset level, and at the total portfolio level, if you move to diversify the risk, then there's not so much of an impact. So I think that was interesting to people to see how their model played that out. Now, there are other people that also give models that you can use. MSCI and Barra have ways of looking at it, and other providers do too. And I might say at this point that we do in the document have an appendix, and scattered through the document a whole set of service providers that we are asked to tell us what they would say they can provide to investors for use. We don't, and I think Chris will say at the end, there's no way that WR and UNEP endorse these or are trying to promote them, but we wish to have a list of people there that you could look at if you were wondering, well, who does this and who does that? Who assesses carbon footprinting? Who optimizes portfolios? Where do I go for stress testing? So on the next page, we get to what do we do? And here I put in the top of it mandate dependent. And one of the things that's obvious is that you know, if you want to divest, you've got to have a mandate to divest. If you want to engage to some extent, even you need a mandate for that. And diversification, you need a mandate to diversify. You know, at an equities level, if you've got a passive index fund, you exactly can't diversify in that sense at the equity level. So our big ideas are not particularly rocket science, where people are looking for disclosure. We've talked about that. They can diversify if they've got the mandate. They can engage if they've got the mandate to see if the operators would change the way they're operating and reduce the carbon risk that way. And then, of course, you have finally got divestment if that's something you can do. We did in this table separate between new investments and current holdings. And there is a slight difference, but I think in general you're going to see those actions showing up at different points on both of the ways, whether you're investing new or you've got current holdings. So again, we go into those in more detail in the document, and I think I've now kept to my 15 minutes, so I'm going to turn it back to Chris. Oh, sorry, I always forget to do the summary. And I like to always say when this chart comes up, you know, as an Excel side analyst, I can tell you if you write a document and someone remembers one chart, you've done it, and a year later, you always feel very happy. So essentially, this would be the chart we might hope you remember and you might find useful, because it is the total summary of everything I've really said. It's got all the factors in, it's got the process in, what we think happens. And so we hope that that's of use to people if they really want to get just a quick snapshot of the process. Over to you, Chris.
Thanks, Mark. Before I turn it over to our commenter for the day, Rosemary Bissett, I just wanted to briefly say we've had a lot of people join since the start of the call. Again, to repeat the logistics, after roughly 5 minutes of comments here, we're going to have a Q&A session, but we are going to leave everybody on mute for sound quality reasons. So if you do have questions based on the content of the report, just type them into the questions box starting anytime. And we will answer them after comments from Rosemary. So I'll turn it back to Rosemary.
Thank you very much, Chris. Okay, some comments and reflections, and it was really useful to participate in the process and review the document. I think what I need to say first up is that NAB considers that the standardisation of carbon risk metrics is very important, so that we can have meaningful conversations and you've got good information to guide decision making on investments and lending, and I guess investments in mitigating risk and taking opportunities, which if you've got good carbon risk metrics you'll be able to do. With the need for these metrics are there internally, so we think particularly in the finance sector you need to be able to, as I guess has already been spoken about, to be able to assess risk when you're doing sort of ESG risk assessments at a client level and understand the risks that a clients are facing into, and that means and you need to be able to sometimes compare, you know, client to client, and understand how the different clients sit in the sector to see the different risks they represent. So you do need data that's standardised so you can compare in a meaningful way as you're looking at credit risk. Then you actually need to be able to have metrics that are meaningful at a portfolio level as well, so that you can understand the sort of aggregated view of the risk that you have. So that's kind of internal use, but then we're also seeing financial institutions and others having to respond to understandable requests by investors for disclosure of carbon risk, so that investors that are investing in the finance sector or in other sectors that are energy or greenhouse intensive can understand and balance the risks that they face as investors. And in addition to the investors, then you've got the general community, sort of led by the NGO movement, expressing a lot of concern about climate change, and they're asking questions about investment, well, the investments that financial institutions make and what their portfolios look like. So in Australia, last AGM season for the banks, there were shareholder resolutions for the first time around disclosure on carbon risk. And so if you don't have standardised, well understood carbon metrics, then you can't provide that information, particularly when directors, if you're disclosing information that's going to influence market decisions, and you've got all those fiduciary responsibilities around market disclosures and making sure you don't mislead the market, then being able to have credible, comparable information is extremely important. So this is really important work. Looking at the document and just some of the things that particularly Mark's highlighted, I think when I was looking at the risks, I would add one risk to the group of risks that are not there. I think physical risks are not mentioned, and there is something that additionally people need to think about, as physical risks will be something that we need to be able to track the impact of in terms of portfolios and climate impacts. So at the moment we're looking at sectors like power generation, coal mining, etc., and they're the typical ones everyone focuses on. But if you think about climate change risk represented by investment portfolios and lending portfolios, then you've got a whole group of sectors that are not contributing to the problem but suffering from the impacts. And so our risk metrics related to climate change, I think, need to actually look at those sectors as well. So agri sector, for example, power will be affected by drought, and so there's this actually having the metrics that allow you to see carbon and impacts is really, really important. I think the time horizons points that Mark made are really valid and very important, and we've noticed that as we're using these metrics internally to track change and looking at the change in markets, the interesting phenomenon which you did mention is that things are speeding up. So you don't necessarily have a crystal ball that's giving you the exact date when things will happen, but in the Australian marketplace with, for example, the deployment of rooftop solar, the structural change in the energy market here is happening way faster than originally people might have predicted. And so having these metrics and monitoring them closely to actually see when you reach tipping points and material change is going to happen is important. And in light of that, then thinking about carbon risk and if you're in a lending environment, the tenor of what you do in terms of your decision making. So what's the time horizon which you're prepared to lend to certain things given the shift in markets, and that you need to have, banks and investors, well, investors have an opportunity to move potentially funds more quickly if it's if you're just buying shares. But if you're actually investing capital in infrastructure or you're lending, then you've not got the liquidity to respond so quickly. So using these metrics to understand what's happening in terms of carbon risk is going to be really important in terms of monitoring change and being able to respond to it quickly over time. What else did I have? I think that at a high level probably covers some of the key things, but yeah, I think this is a really important and useful report, and it will be interesting to see how people use it and to see if that means that we, I guess, what's the word, get to a point where there is an agreed set of metrics that help people understand carbon risk through because if you don't manage it, if you don't measure it, you can't manage it, and I think that's what we're all trying to do. We're actually trying to understand and manage the risk so that we don't see we see an orderly transition to a clean energy future rather than abrupt changes that make it very, very hard to manage the risk.